welcome you. Let's get straight to it.
Yeah.
You're here because you want your money to work harder. Right. And that's exactly what we're diving into today. Think of this as your personal shortcut to understanding a game-changing concept, asset allocation.
That's right. We're going to unpack what asset allocation truly is, why it's absolutely crucial for building your wealth, and how different approaches can lead to vastly different financial outcomes for you over time.
And to make this as practical as possible, we've got some fantastic material transcripts from the Good Finance YouTube channel. These are real-world discussions, not stuffy lectures, packed with examples of how investing and asset allocation play out in everyday life.
Yeah, our goal is simple, to give you actionable insights into asset allocation. We'll be focusing on the core principles and real examples from these sources so you can understand the vital decisions involved in, well, how you put your money to work.
Okay, so let's start with the basics. What exactly is asset allocation?
In simple terms, it's about deciding where you put your money across different types of assets. Think of it like building a well-rounded team for a game. You need different players with different skills. Our sources mention a wide range of possibilities, from familiar things like fixed deposits, real estate, land.
Right, the usual suspects.
Exactly. And even those informal savings clubs you might know about. Then there are more complex options like mutual funds, bonds, stocks, lending for interest, insurance, business partnerships, structured products, venture capital, private equity funds, derivatives, commodities, futures, options, arbitrage, hedge funds. The list goes on.
Okay, that's a lot.
It is. But the real key isn't just naming all these things. It's about the proportion of your money you allocate to each. How much goes where?
Right. It's not just about picking a few investments here and there, but about having an intentional overall strategy. And this strategy, according to our sources, has a massive impact.
Absolutely. The transcripts emphasize that this decision, how you allocate your assets, is the primary driver of your long-term wealth growth. There's a really relatable story about the speaker's father. He started by keeping almost everything in savings, which is, very safe, but typically low growth. Later, he considered going all in on stocks, a much higher risk, higher potential reward strategy. These two extremes perfectly illustrate how your asset allocation choices directly shape your financial journey, for better or worse.
So before we dig into different ways to divide our money, it's important to understand the fundamental types of assets we're talking about. And our sources bring in a pretty well-known expert here, Warren Buffett.
That's right. Buffett offers a simplified but powerful way to think about assets by dividing them into three main categories. First, he talks about currency-type assets.
Okay.
These are your most liquid and generally most stable forms of money. This includes cash, your checking and savings accounts, time deposits, savings-focused insurance policies, and even bonds, both government bonds.
Like lending to the government.
Yeah, exactly. And corporate bonds, which is lending to companies. These are generally considered lower risk, but also tend to offer lower potential returns.
So these are the things that feel the safest and most easily accessible. What's his second category?
The second is non-productive assets. Now, this might sound a bit surprising, but these are assets that don't inherently create more of themselves. The source specifically mentions safety deposit boxes considered speculative here because their value depends on what's inside and someone else wanting it later, and gold.
Gold, but that's often seen as a really secure investment, a hedge against inflation.
It is, and it can play that role. But from Buffett's perspective, as shared in our sources, gold doesn't have inherent productivity. Think about it. If you have a gold bar, it just sits there.
Right.
It doesn't produce more gold, and it doesn't generate income like a business or rental property would. Its value goes up or down based on market sentiment and demand, not because it's creating more value itself.
Okay, that distinction makes sense. It's about whether the asset itself generates further value. So what's the third category?
The final category is productive assets. These are the ones Buffett favors for building wealth over the long haul because they have the capacity to grow and generate ongoing income or value. Examples include real estate that you rent out for income,
Makes sense.
farmland that produces crops, and businesses that create transactions, goods, or services. These assets, unlike gold, have the potential to continuously create more value over time. Understanding these three categories, currency type, non-productive, and productive, is really the foundation for making smart decisions about how to allocate your assets.
Now, as we start thinking about putting our money into these different buckets, two really important things come to mind. How risky is it, and what kind of return can I expect? And our sources illustrate this with a helpful comparison.
Yes, there's a comparison between an investment with a, let's say, stable 3% return and one with a more volatile 15% return, shown with charts. The stable 3% could represent things like government bonds or time deposits, generally lower risk and lower return, showing a slow but steady upward climb.
Predictable, mostly.
Right. The volatile 15%, on the other hand, represents investments like stocks, which represent ownership in companies. Stocks have the potential for much higher growth, but their prices can also swing up and down quite dramatically in the short term. Big swings.
And it's so interesting how our emotions play into this, as the source points out. It's not just numbers.
Absolutely. While the idea of a 15% return sounds great, actually experiencing the ups and downs that come with it can be tough psychologically. The source talks about the excitement when your investments are gaining, but then the worry and even despair when they drop.
Yeah, that dip feels bad.
It does. And this emotional roller coaster can lead to making some really bad decisions, like selling when the market is down, locking in losses, or getting caught up in the hype, FOMO, and buying high just before a downturn.
It really highlights that investing isn't just about numbers on a screen, is it? It's about real stuff.
Exactly. The sources emphasize that real investment is about supporting actual businesses or ventures that are creating value and generating returns over the long term. Think about the early investors who funded Columbus's voyages, or today, people who buy shares in a company like TSMC because they believe in its technology and future growth in the semiconductor industry.
Right, you're back in the company.
You are. And this kind of investing requires patience and a willingness to forego some immediate spending for the potential of much greater rewards down the line, sacrificing now for later.
And this directly relates to how long you plan to keep your money invested, your time horizon.
Precisely. Your investment choices should be closely tied to when you'll need to use that money. For short-term goals like needing funds for your daughter's tuition in the next few months, you'd want to prioritize those stable, lower return investments to protect against any sudden market drops. You need that cash soon.
Can't risk it dropping 20%.
Exactly. But for long-term goals like retirement or maybe a down payment you might need in 10 or 15 years, you have more time to ride out any potential volatility. So you can consider growth-oriented investments like stocks, which have historically provided higher average returns over longer periods.
More time, more potential growth.
Right. The source even uses a great analogy, cautioning against using only stable investments for long-term goals. It's like buying just a blanket when you actually need to build a whole house.
Yeah.
You need growth for those big, distant goals.
That's a good way to put it. And it's a good reminder that when you buy a stock, you're not just buying a fluctuating price, you're buying a share of a real company and its future potential.
That's a really important shift in perspective. Now let's take a step back and look at the bigger picture. What actually drives wealth creation in the first place? Our sources touch on this, drawing from a video called Iomi Mon, The Key to Prosperity.
Okay, so what are the fundamental forces at work here? The big picture stuff.
The sources explain that the core drivers of wealth are the division of labor and increasing productivity. They use simple, early examples like people living in the mountains who specialize. One catches fish, another picks fruit, and then they trade.
Right, specialization.
Yeah. This specialization means more of both gets produced overall, leading to greater abundance for everyone. As communities grow into villages, you have even more specialized skills and greater overall wealth. The Industrial Revolution is highlighted as a massive leap forward in productivity thanks to factories and new technologies. Huge jump.
It's incredible to think about how much our ability to produce things has increased over time.
Absolutely. The sources even mention Adam Smith's The Wealth of Nations, pointing out that even ordinary workers in England centuries ago had access to more goods and a better standard of living than tribal leaders in less developed societies, all because of this increased productivity and division of labor.
Wow.
The example of the iPhone is particularly powerful today. Think about all the different companies and specialized workers across the globe involved in designing, manufacturing, assembling a single phone. This intricate global supply chain is a perfect illustration of how specialization drives massive wealth creation.
And the data supports this long-term growth, right? The numbers show it.
It does. The sources mention the growth in global GDP between 1990 and 2018, and the long-term upward trends of major stock market indexes like the Hang Seng and the S&P 500 from 1950 to 2019. These trends reflect the overall expansion of the global economy and the potential for individuals like you to benefit from that growth through investment.
So who are the key people driving this continuous increase in productivity and wealth?
The sources emphasize that entrepreneurs are the primary drivers of wealth creation. These are the people who come up with new ideas, organize businesses, and ultimately create value for others. They give examples of the phenomenal growth of companies like Apple. Its market value increased 144 times in just 16 years.
144 times. Incredible.
Yeah, as well as the significant returns generated by companies like Tencent, Kwaichamutai, and TSMC in relatively short periods. These examples show how innovative companies, led by capable individuals and teams, are at the forefront of generating economic value.
And that brings us right back to the idea of investing in stocks, doesn't it? Buying a piece of that value creation.
Exactly. The source poses a really insightful question. If you appreciate the value and usefulness of a product like an iPhone, shouldn't you consider investing in the company that makes it? The logic is that if you believe in a company's ability to create value for consumers, then investing in its stock allows you to potentially share in its financial success and the wealth it generates.
This idea of owning a piece of these value-creating engines leads us to the fundamental concept of stocks representing ownership, and our sources delve into the history of this. It goes way back.
They trace the origins of the stock market back to the Dutch East India Company in 1606. This was a groundbreaking innovation that emerged out of a practical need. Merchants needed to pool their resources to finance those long and risky sea voyages. Huge risks involved.
Yeah, ships could sink, pirates.
Exactly. So instead of one person shouldering all the risk, multiple individuals could invest a portion of the capital needed. If the voyage was successful and profitable, everyone who invested would share in those profits proportionally.
So that early share essentially represented a piece of the ship and the potential profits from its cargo, like a tiny slice of the adventure.
Precisely. And over time, this evolved into the modern concept of a stock representing partial ownership in a company. The sources outline the key rights that come with being a shareholder, including that partial ownership stake, the right to vote on important company decisions, the right to receive a portion of any dividends the company distributes.
Getting paid out from profits.
Right. Plus a claim on the company's assets if it were to be liquidated, and also what are called preemptive rights, which basically give existing shareholders the first opportunity to buy any new shares the company might issue in the future, helping them maintain their current percentage of ownership.
So it's much more than just a ticker symbol scrolling on a screen. It's a stake in a real ongoing business.
Absolutely. And the sources emphasize that the fundamental purpose of stocks hasn't really changed since the 17th century. It's about providing capital to support new ventures, sharing in the risks and potential rewards, and ultimately contributing to future prosperity by funding innovation and growth.
And this shift from primarily owning land to owning shares in companies marked a huge turning point in how wealth is created and distributed, didn't it? A whole new game.
It was transformative. The emergence of the Amsterdam Stock Exchange in 1602 was a pivotal moment. Before then, land ownership was the dominant form of wealth and social standing. But as companies became more efficient and productive, generating greater economic value than land in many cases, a new era of wealth creation centered around these stock markets began.
So the engine of wealth shifted.
It did. The sources point out that if you look at the wealthiest people in the world today, their fortunes are almost always tied to ownership in companies that are traded on these exchanges. Think Bezos, Musk, Gates.
Right, tied to big companies.
Well,
It's fascinating how that power dynamic shifted. But the sources also point out that there's a potential disconnect in how many people approach the stock market today.
that's a really critical observation. While the stock market represents ownership in these productive enterprises, a lot of people treat it more like a casino, focusing solely on trying to predict short-term price movements without really understanding the businesses they're investing in.
You're just watching the price go up and down.
Exactly. The sources use TSMC, a leading manufacturer of semiconductors, as an example, asking whether most of the people buying and selling its stock really understand its competitive advantages and the complexities of the semiconductor industry. Probably not, right?
Probably not most traders, yeah.
So buying a stock just because you think the price will go up without understanding the underlying business is really no different than gambling on any other random token or number. It's speculation, not investing.
So what should our focus be instead, if not just the price?
The sources argue that the real value of investing in stocks comes from entrusting your capital to capable management teams. They even call them the smart brains, who have the expertise to run and grow successful businesses.
Backing the people running the show.
Right. By investing in their companies, you can potentially share in their profits and long-term success without having to take on the day-to-day burdens of running the business yourself. They give examples of visionary leaders like Bill Gates in software, Steve Jobs and Tim Cook in hardware, Warren Buffett in investing itself, Morris Chang in semiconductors, Wang Yongqing in plastics, and Li Ka-shing in Hong Kong business. These are all examples of individuals and teams that investors are essentially backing with their capital, trusting them to grow the pie.
This long-term perspective seems to be a recurring theme, especially when we consider the short-term ups and downs of stock prices, which our sources tackle directly, the day-to-day noise.
They certainly do. Using Apple's stock performance over a 16-year period as a prime example, they highlight that while the stock delivered incredible long-term growth, increasing 145 times in value, remember?
Yeah, staggering.
It also experienced a significant number of down days, almost as many as up days, roughly 47% down, 53% up. This perfectly illustrates the inherent unpredictability of stock prices in the short term.
Basically a coin flip day to day.
Pretty much. The source even jokes that trying to predict whether a stock will go up or down tomorrow is about as reliable as flipping a coin.
And yet so much of the news and discussion around the market focuses on these short-term swings. Market surges, market plunges.
Exactly. It's noise. Despite the near equal number of up and down days for Apple, the overall trend over those 16 years was overwhelmingly positive. This underscores the importance of staying focused on the long-term potential and not getting distracted by the daily fluctuations. The sources strongly state and even repeat for emphasis: stock prices are unpredictable in the short term.
Got it. Unpredictable short term.
They really caution against believing anyone who claims to have a foolproof method for predicting these short-term movements. If they could, they wouldn't be telling you.
Good point. They also give a pretty dramatic example of this short-term unpredictability within a single year, right? Even for a solid company.
Yes. They point out that even a fundamentally strong company like Apple can see its stock price move quite significantly within a single year, for example. It might drop by 45% and then rise by 84%, all while the company's core business, its products, its leadership, its customer base, all remain relatively consistent.
So the price swings way more than the actual business changes in the short term.
Precisely. This really highlights the disconnect that can happen between short-term price movements and the underlying long-term value of a company. The advice is clear. Be honest with yourself and others. Nobody can reliably predict where the market will go in the short run, period.
Okay. So with all these factors, we've discussed the different types of assets, risk and return, our time horizon, the power of productivity, and the unpredictability of short-term prices. Where does asset allocation really fit in terms of its importance for our financial success? Our sources have a very clear answer to this.
They do. Drawing on the influential work of David Swensen, the longtime and highly successful Chief Investment Officer of Yale University.
Yes, the Yale endowment guy.
That's him. The sources state very clearly that asset allocation accounts for a whopping 90% of your investment success. That is a massive number and a key takeaway for you listening: 90%.
90, wow. Okay.
Swensen identified three main factors that influence how well your investments perform. When you invest, market timing, what specific investments you choose, stock picking, and how you divide your money across different types of assets, asset allocation. And his research strongly suggests that this initial strategic decision of how you allocate your assets has a far greater and more lasting impact on your financial results than trying to perfectly time the market or pick the winning individual stock.
Which is what most people focus on.
Exactly. Market timing and stock picking together only account for about 10% of your investment outcome, according to this research. Asset allocation is the big one.
Wow, that really puts things in perspective. It's not about trying to find that one winning stock. It's about having the right overall plan in place from the start. And they share a personal story to really illustrate this point, don't they?
Yes. The speaker recounts his father's decisions early in his career, deciding whether to put his savings into very safe fixed deposits or into land. These fundamental asset allocation choices made decades ago had a profound impact on his financial well-being and, consequently, on the speaker's own life.
Decisions echoing through decades.
Right. The source even suggests that if his father had consistently bought land at the absolute highest price points over the past 50 years, he would still likely be significantly wealthier today than if he had kept all his money in a bank account earning minimal interest. This really drives home the long-term power of even relatively simple asset allocation decisions. Choosing the right type of asset mattered more than timing.
So having a thoughtful and well-considered asset allocation strategy is absolutely crucial. And this naturally leads us to the importance of having realistic expectations for our investment returns and understanding the power of long-term growth, managing those hopes and fears.
Exactly. The sources explain that having unrealistic expectations for your investment returns, whether you're expecting too much too quickly or you're underestimating the potential for long-term growth, can be harmful. Expecting overly high returns might lead you to take on too much risk and confuse speculation with actual investing, chasing unicorns. On the other hand, underestimating the potential returns, especially over long periods, can lead to missed opportunities, especially when you consider the incredible power of compounding, letting inflation eat away at your savings.
So finding that balance, and they provide some historical data to help us set more realistic expectations, right? Some actual numbers.
Yes, they present the average annual returns of different asset classes in the U.S. over an 80-year period, from 1926 to 2006, based on research by Jeremy Siegel. Small cap stocks averaged around 13% per year.
Smaller companies, higher growth potential, maybe?
Generally, yeah, but more risk, too. Large cap stocks averaged about 10%, government bonds 5.3%, and cash only 3.7%. This historical data gives us a valuable benchmark for understanding what reasonable long-term returns might look like in a mature market. It's a guide, not a guarantee, of course.
But it helps frame things. And this also highlights the fundamental relationship between risk and potential reward, doesn't it? Stocks versus bonds again.
Precisely. Stockholders, as owners of the business, generally take on more risk than bondholders, who are essentially lending money to the company. They get paid first if things go bad. But this higher risk for stockholders comes with the potential for significantly greater rewards if the company is successful and grows over time. You share in the upside.
More risk, more potential reward.
Exactly. The sources also reiterate Buffett's preference for productive assets like farmland and businesses, represented by stocks, over non-productive assets like gold and art, which rely solely on someone else being willing to pay more for them later.
The greater fool theory sometimes.
Kind of, yeah. And also over-depreciating assets like cash, which loses purchasing power over time due to inflation. Productive assets, as we discussed, generate ongoing value. Crops grow, businesses make things or provide services.
And looking at the really long-term historical data really underscores the power of investing in those productive assets, especially stocks. The super long view.
Absolutely. Using a log-scale chart that goes back over 2 centuries, from 1801 to 2006, again based on Siegel's work, the sources illustrate the dramatic long-term growth of different asset classes. It's stunning, starting with just $1 in 1801.
Okay, $1.
By 2006, that dollar would have grown to only 0.049 cents in cash. It actually lost value due to inflation.
Well, less than a nickel.
Right. It would be $3.26 in gold, $265 in treasury bills, short-term government debt, $1,663 in long-term government bonds. And wait for it, a staggering $1.34 million in stocks.
$1 became over $1 million.
In stocks, yes, over 200 years. This long-term historical perspective really reveals the underlying trends and the exceptional potential for wealth creation that stocks have offered over the very long run, driven by that continuous productivity and value creation we talked about earlier. It shows the power of compounding in productive assets.
So bringing it all together then, what's the most important thing you, our listener, should take away from our deep dive today? The main point.
The core message is clear and powerful. Your asset allocation, how you choose to divide your money across different types of assets, those buckets we talked about, is the single most critical factor in determining your long-term financial success and your ability to reach your financial goals. It's the 90% factor.
It's about understanding the fundamental nature of those different asset classes, the currency type, the non-productive, and especially the productive ones, and making deliberate decisions about how to allocate your capital based on your individual time horizon, your personal tolerance for risk, and your specific financial objectives. Your situation.
Exactly. So as you consider this historical data on how different asset classes have performed over the long run, and you think about the incredible power of long-term productivity and value creation, here's a final thought for you. What adjustments, if any, might you consider making to your own current asset allocation to better align with the financial future you envision for yourself?
A practical question to ponder.
Yeah, really think about the balance you currently have between those stable, lower growth assets and the potentially more volatile but historically higher returning growth-oriented assets. How does that mix relate to your unique circumstances, your age, your goals, and your long-term aspirations? It's worth thinking about.